So a question we hear all the time is, why do parents set up a whole life insurance policy for their kids? There's several reasons why a parent would take out a life insurance policy for their kids. It never is the life insurance because their kids typically don't need life insurance. It always has to do with the cash values. But there's three main reasons that we've seen consistently over the years. The first reason is saving money for college. When you look at the cash value in a whole life insurance policy, it's guaranteed to increase, and I can also easily access that cash value to pay for college when the time for school comes. The second reason is when a family is setting up policies that are on their children in a trust, and typically the family has a family office structure or it's something they plan on establishing and they want to create generational wealth. So when you look at families that have a lot of wealth within the family, typically what you'll see is a trust or a series of trusts where you have family members that have life insurance policies on them. The trust or trusts own the life insurance policies and are also the beneficiaries of the life insurance policies. So this way, if I start a policy on an infant or a 5-year-old and I continue to feed that policy, by the time they're 60 or 70 years old, that policy is going to be worth millions, probably tens of millions of dollars, depending on how much I funded that policy with. And then the death benefit is paid income tax-free to the trust, which then establishes new policies on new children and grandchildren, and you continue to compound that wealth. Life insurance has always been used as a strategy really to create perpetual wealth when you look at how it can be used. But we do see this quite a bit. Families are attracted to this concept, and it's not just the long-term death benefit. The cash value is being used for opportunities all the way through. So you'll see parents set up policies for their children for long-term wealth and also having access to the cash value throughout the child's life. And then the third reason is pretty simple. The parent likes the cash value. They usually have a policy themselves, and they just want to start a policy for their kid because they say, I wish I would have had this when I was a kid. Like if my parent would have started a policy for me when I was 5 years old, I see the value of it today. Man, I wish I would have knew about this earlier. So they're starting that for their child right now, which is really, really nice. And there's a lot of different ways to do this. You can start with a very small policy. If I'm paying a few $100s per year, maybe it's $3,000 per year. We've got one individual that has two policies on his two children, so one on each, where he pays $50,000 per year on each of them. That's a total of $100,000 per year. Now, he does very well financially, so he has the means to do that, but he's funding policies for his children. So when they eventually obtain these policies and they have access to it, they're going to have a huge amount of cash value to work with. But a common approach would be this. I want to fund a policy for my child with $3,000 per year. The parents will typically fund the policy until the child is an adult. When the child is 18 or maybe 21 years old, really at whatever age the parents decide, they can either stop paying the premium altogether, and you can set the policy up to stop at a certain age when you first start it, so it can stop altogether, or they can tell their child, hey, I funded this policy with $3,000 per year for you for the past 20 years. I'm giving it to you. This is yours now. Now, the child, let's say they're 25 years old, has this policy and the premium payment or the funding amount is $3,000 per year. When you were 25, do you feel like funding $3,000 per year was something that would have been very, very easy for you to do? Or you may have struggled? I probably would have struggled at 25. Definitely earlier, 25, I might have been able to do it, but it may have stressed me out a little bit. So my point is, with that setup of the $3,000 per year policy, are they billed for $3,000 every year? Is that the requirement? No, we would definitely not do it that way. The minimum would be $300 per year. And we would talk about this with the parents when we first set the policy up. So if they plan on saying to their child, hey, when you're 25 years old, or just telling them when they are 25, here's your policy. I've been funding $3,000 per year. Here's what it looks like if you keep on paying $3,000 per year, but you don't have to do that. You can pay only $300 per year. Oh, thanks, Mom and Dad. I didn't know I could do that. That's a small amount. It doesn't stress me out. And then as my income increases, I know I can fund up to $3,000 per year. My point is, we set it up to be very flexible. This way, the policy never feels like a burden, because where this can go south and where I've seen this happen is when a parent puts a lot of time and money into this policy for their child, and it's got a positive cash value, a lot more in value than what the parent has paid in. They give it to the kid. They want the kid to continue to feed the policy, but the kid feels like it's a burden. Oh, I gotta make this payment. It stresses me out. I don't really understand it yet, even though Mom and Dad went over it with me. I don't get it, but I see this big bucket of cash value here. I'll just cash it out because I don't need the life insurance. Then Mom and Dad say, "What did you do?" Well, the child didn't know about the policy. He didn't really understand the pros and cons. But the main reason why he did that from an emotional standpoint is because he felt like it was a $3,000 bill. Whereas if it's a $300 minimum, and you can even stop paying altogether if that stresses you out, and you see it continue to grow, you take away that stressor, and now you see the benefits. And then as we mature into a young adult, into our mid-30s, 40s, we get more and more mature, then we see the value and we say, oh, okay, I see if I keep adding money, this thing looks really good. So really what we want to do is set it up where the cash value is optimized when the parents are paying into it, because they can access it. They'll be the owners originally, but then when the child eventually takes over, the policy doesn't feel like a burden at all. That's key there, and that's really where we see people hold on to these policies for the long term, because you're taking away the what if scenario, or I should say a child's what if scenario. What if I can't pay this big premium I think I have to pay? You don't, but if it's not there, it makes it a lot easier for a kid not to have to pay it. So that's usually how parents set up policies for their children. Those are the three main reasons why. I hope this video has been helpful. If you'd like to see a detailed case study of how parents set up policies for their kids, you can see that in this video here. Thanks so much for watching.